Yo, what's up guys? I just want to make a quick video talking about the setups that I look for, how you can look for them, how to enter these setups, all the different criteria that I look for to enter, where to put your take profit and stop loss, or at least what I do, and just examples, and also how to tell between an A plus setup and like a B minus, C minus setup. So let's get right into it. First of all, I know this looks like childish or whatever, but think about it like this, right? So the green lines that I have are going to be price, like the candlesticks, for example. Purple line is going to be the 8-day moving average. Blue line is going to be the 21-day moving average, all right? So these are the three main types of setups that I look for. Right here on the left is sometimes called a flagpole pennant. One in the middle is usually called like a flagpole flat top triangle, whatever you want to call it. And this one on the right is called the wedge pop. So again, the green line is going to show the price, the candlesticks. The purple line's 8-day moving average, blue line's 21-day moving average. So on these setups, this is kind of what you want to see on the flagpole pennant setups, right? You want to see a run up with the moving averages in place usually. And if they aren't in place, right, like if the 8-day moving average is below the 21-day, you want to see it get above when it starts consolidating right here. So this is what you see right here. Moving averages are in place, again, 8 days above the 21-day. And as this run-up finishes and it starts consolidating here, while this is happening, you want to see decreasing volume, okay? Like you want to see a lot of volume in the run-up, but you want to see a decrease in volume while it's consolidating, and you also want to see it form lower highs and higher lows, which means it's tightening up. And then right here on breakout day, you want to see a breakout of the trend with huge volume, and hopefully the breakout happens when it is just tapping the 8-day moving average. So it hits the 8-day moving average and then spikes up. That's what you want to see with that one. This one right here, the flat top, very similar. 8-day and 21 are in place, so the 8's above the 21. And then you want to see price come down, test the 8-day, support it, and then when it breaks out right here, again, you want to see a breakout with high volume with the moving averages in place. And again, just to put this into your brain, you want to see decreasing volume while it's consolidating, but big volume on breakout and big volume on the run up. Now the wedge pop, you're going to see a run up again a lot of times with the moving averages in place, but then it forms this like consolidation downtrend phase where the moving averages typically lose its place, right? They form like a downwards momentum, right? The 8's below the 21 is below the 50-day, etc. But then price breaks above the trend and above the moving averages. The 8 goes back above the 21-day moving average. Price respects it and goes up. So with these wedge pops, you'll typically see a breakout of the wedge and then a small consolidation phase again for the EMAs waiting to get back into order, and then a spike off the EMAs. Now I'm going to show you examples of all three of these in today's video. So the first one is going to be the flagpole setup that I talked about right here. This is going to be on SOUN. Now as you see, like I said, flagpole pennant setup. So you see the run up right here, and then you see the consolidation, and then you see the breakout. Pay attention to this, guys. Like I said, the run up has increasing volume, but during the consolidation phase it has decreasing volume. That's exactly what you want to see. And all that, what do you notice? The moving averages are in place, okay? Now on my chart, the 8-day moving average is the white line, the 21-day moving average is the red line. The green line is the 50-day, and the dark gray is the 200-day moving average. So again, you see increased volume in the run-up, and then you see a decrease in volume during the consolidation phase. And in this consolidation phase, it's forming higher lows, but also lower highs, like I said, so it's tightening up. And it's also respecting the 8-day moving average. That's exactly what you want to see. And then finally, it breaks out of this trend with volume. Even though it doesn't look like a lot of volume, it actually is, because it's above or at least touching the volume moving average. And what that is, if you just open up your volume indicator, check that, it forms a moving average for the volume bars. Very important. Anything below is low volume. Anything above the moving average is high volume. So again, it's like right there. Breakout above. Boom. Breakout day, as you can see, run up. Literally the exact drawing that I just showed you guys. Now, how could you have caught this? So again, I told you my criteria. You want the decreasing volume, you want the moving averages is in place and you want price to respect the moving averages. So let's say you saw the setup. How do you enter? My entry model is typically a break of the trend or a break of the previous day's high on the 15-minute chart, or a lot of times, like on this, it's going to be a daily close. It just depends on setup to setup. And then also, if a stock's ADR percent is not above 2.5% minimum, I am not going to trade that stock, because the ADR percent is the average daily range. So that means it moves on average that percent per day. If it's anything below 2.5%, it's a slow mover. Anything above, it's a fast mover. Anything above 5% is really my sweet spot, but I'll still take anything above 2.5%. So it hits all my criteria. So now how do I enter this trade? I really like previous day high breaks for my entries, but if we look at this, the previous day high is so high up, I would have missed a lot of the move. My entry would have sucked. So on this one, especially because earlier in the day we came down so much, I was going to wait for a daily close. So I waited for the daily close. We respected the 21-day moving average, and we closed above the 8-day moving average and above the trend with volume. Perfect entry. I buy my calls. Boom. Now where would my take profit be? Like I said, I would talk about that. First trim was going to be at this previous high. Like I talked about on the drawing, it often tests this previous high. And then I trimmed again at a previous resistance level. And then bam, that's the trade, guys. Very simple, right? It just took a few days for it to play out. But again, textbook. I'm just going to go through this one more time. ADR percent is above 2.5. There's an increase in volume with the run-up. Decrease in volume with the consolidation phase. Well, in the consolidation phase, it's lower highs and higher lows, and it respects the 8-day moving average. Breaks out with volume, and moving averages are in place. Study this setup, guys. It is literally textbook, and you can put this exact setup into so many different stocks and see exactly what I'm talking about. Just real quick, guys. I wanted to add that my stop loss is usually the low of day on the day that I enter, because it sets up for some really tight RRs, like risk to rewards, and by the time it breaks the low of day, that means that the move might be done, the momentum might be killed, or it might need a few more days for it to happen. So usually it's the low of day. Sometimes it's a little bit higher if the low of day is too far. Sometimes it's a little lower than the low of day, depending if it just doesn't make sense. But again, general rule for me is low of day, and I can just play around with it and see what actually makes sense for you and your account. All right, next up, guys, I talked about is the flat top, the second one. It's right here, perfect example. We have, now, technically this isn't a run-up because it was a gap up and then dropped, but let's count it as our run-up, okay, because it gapped up. So we have our run-up right here, right? It gapped up with a lot of volume, came back down, tested the moving averages, supported the moving averages, came back up to this previous high, couldn't break it. All right, so what do you think that is? Resistance level. While it's consolidating here, notice a decrease in volume from the main run-up. And then take a look at this, guys. This right here, previous day high, 1066, right? So I'm watching this. This is on my focus list because the moving averages are in place. ADR is above 5%. Consolidation is beautiful with low volume, and the run-up had high volume, and it's just looking really nice for a breakout, especially because of the moving averages being in place. And also another thing I like to add is if the MACD is green. So how would I enter this trade? So on this one, because like I said, the previous day high was this low, I was going to wait for a previous day high close on the 15-minute chart. So on September 18th, 15-minute closed above. I believe it got in around 1070, and it was also a bounce off the AEMA, so that was a perfect entry. It also had volume, so again, perfect. And then I aimed, my first trim was, I believe, literally at the end of the day, and I took full profits around $13 because previous level, and also because it was extended from the EMAs. Didn't think it would go up that much, and as you can see, it didn't. So again, another really nice trade right here, guys. Really textbook, flat top, and now you can use those. Now a textbook wedge pop here is going to be bull. Now this actually hasn't played out yet, and it may not, right? This might fail, but this is going to be one of my hopefully best trades of the year if it plays out fully. But let me get into why. Okay, so I told you guys on these wedge pops, you'll see run up with volume, downtrend consolidation phase, EMA is not in order. then it breaks out, consolidates again, EMAs get in order, and then rockets. So again, that's exactly what I'm seeing here. I'm not going to trim until 1708, and then full profit at 1832 or $20 depending on price action. But take a look, guys. We break out, we consolidate again, we retest the breakout level, and then we rocket off that. As soon as I noticed we started supporting this breakout level, and then we reclaimed the moving averages, right around $14 I bought my position. Why? Because of exactly what I just told you. We respected the moving averages and the breakout level with volume, and the MACD is green again, and ADR percent is above 5%. I also believe Bull is lagging behind SoFi and Robinhood in terms of financial brokers like that. So another textbook wedge pop, at least for now. Obviously this could fail, but focus list this and pay attention to it, see what happens. Last thing I want to talk about is failed breakout. So right here, textbook setup, moving averages are in place, ADR is above 5%, decreasing volume in consolidation and huge volume in the run-up. Why did this fail? Okay, now I only have shares in this right now because I bought on this day right here, but I bought calls on this day with the break of the previous day's high. Why? Because it broke out, like I said. Everything looked good except volume. Look at the volume on this day, no volume. A lot of times when you enter with no volume, this could happen. I got stopped out here. This is how like an A+ setup can go south, but this is still setting up, and I believe it can go higher. But again, I got in prematurely there because there's no volume. So yeah, guys, that's that video. Let me know what you guys want to see in the future, and let me know if this made sense to you. Let me know if you want me to explain anything in more detail. And I hope you guys learned something and took something away from this video, because if you put this into your trading and pay attention and stick to a system, it's literally just your mind that's stopping you from becoming profitable. So I hope you guys learned. See you in the next one. Peace.